Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Dan Rupp, the founder and CIO of Parkway Capital. After spending many years at a very well-known Asia-focused investment firm called Overlook, Dan founded Parkway Capital to take advantage of some of the less liquid and smaller cap opportunities he was consistently unearthing. Dan is the first Asia-only investor we've had on the podcast, and I was excited to speak with him about the types of opportunities he thought he could invest in with a smaller capital base, how he is building his team and his asset base, the Parkway portfolio, which consists of compounders, defensive companies, and deep value stocks, why he is so constructive on the Chinese market right now, and the investment case for Chinese white goods manufacturer Haier. Dan mentioned a handful of securities on this podcast. I do not own any of them. And without any further ado, here's my conversation with Parkway Capital's Dan Rupp. Dan, you spent a number of years at a very well-respected firm called Overlook. For listeners based in the US who may not be aware of Overlook, can you talk about that firm and its strategy?
Sure. And thanks, Ben. I'm happy to be here. So Overlook was founded in 1991 by an American, Richard Lawrence. And Richard's put up an amazing track record over 30 years, something like 11.5% net returns to investors. I think that beats the S&P over that period. And he's done that against a really difficult market. So he's gotten through the Asian financial crisis, the dot-com bubble, GFC, et cetera. And so he's built a business and he's found a method and a model which delivers compounded returns to investors in difficult markets. He was my main mentor and also James Squire, who's the CIO. He's been the CIO for the last 12 years or so. Richard and James really taught me how to invest and how to treat clients fairly and how to build a business that can last for decades. So I'm eternally grateful for those two for all they've taught me.
Interesting. And so, I think for people who aren't familiar, I think it's a very well-respected shop, with a lot of assets under management. I'm curious, as you were thinking about, where you wanted to be in 5 or 7 years, like what pushed you to finally decide to start Parkway, which is your own firm?
Right. Well, so I've left a multi-billion-dollar fund with this great performance. The main reason I left was that when I joined the firm in 2006, we were about 400 million AUM, and we started looking at companies from Hong Kong, small mid caps to Southeast Asian leaders. And so I kind of continued to look at those companies, and in China basically ended up becoming a big part of the portfolio. While I was, I don't speak Mandarin, so I was still focused on Hong Kong and some of the Southeast Asian names. But a lot of those names, unfortunately, while they were still good companies and they got cheaper and cheaper, they couldn't fit into a large portfolio. And so I decided that there was this great opportunity set that we couldn't address being a multi-billion-dollar firm. So we discussed it internally, and Richard has always felt that it's very important to be a one fund structure. He thinks that's best for his LPs. I totally respect that. I understand it. So I decided to leave in June of last year.
And I'd love to dig into those opportunities and what, kind of like the founding principles and the founding, like kind of a portfolio that Parkway started with. I mean, is it really that you saw companies that were either in markets that were too small or market caps were too small? Like, just give us a sense of like what it was that you thought was so compelling that it merited for basically becoming an entrepreneur versus staying in a place where I'm sure there was a fair amount of resources and stability and all that.
Yeah, it's certainly a trade-off. Being an entrepreneur, it's always been a dream of mine. I got an MBA. It's always been a dream to have my own firm, but it was such a great firm I worked at, it became hard to leave. And so, that's part of the reason why I stayed there for so long. But the opportunity set, there's some pretty obvious answers to that question. I mean, one is in Asia, your listeners may not be aware. I mean, in each market, you have different types of securities. So, for example, in Korea, most companies you hear about that are Korean are going to be the common shares, but there's about 80 or 90 companies in Korea that have a preferred share. Preferred shares actually get a little extra dividend, and they also, they trade with less liquidity, but they trade at discounts generally. And so those discounts can lead to, if you're comparing a common to a preferred, much lower valuations, higher yields, lower multiples, et cetera. The same thing exists in China. Most companies you hear about are going to be A shares that trade either domestically on the Shenzhen or Shanghai exchange. There are also some B shares, and the difference is a B share in China is denominated in Hong Kong dollars or US dollars. Generally, the B shares trade with discounts. We own one share in China. It's a B share, and it trades at a 60% discount to its A share. Another example, our biggest holding, which we can talk about later if you'd like, it's a Chinese company that has 3 share classes, an A share in Shanghai, an H share in Hong Kong, and then a D share. D is for Deutsche, it trades in Frankfurt. So they have a very small number of shares that trade in Germany, and that also comes with about a 60% discount. So when you can find these securities, you do have to tolerate less liquidity. But if you manage a smaller pool of capital, we have a 2-month notice period when people want to redeem. So we can take on, we're not a daily UCITS fund or an ETF. We can take on some illiquidity, provided that we're being compensated for that illiquidity with big discounts and then bigger yields, lower multiples, et cetera.
And as a team, you're covering a number of markets, and there are probably thousands of securities you could potentially invest in. I'm curious how the current makeup of the team, and then how you split up responsibilities. Is it by geography? Is it by market cap? Like how are you delegating and kind of figuring out how to cover that whole universe?
Yeah, let's start with the universe. So we are an Asia ex India fund. So the one difference between Parkway and my prior firm is that we've included Japan in the mandate. I spent 3 years in Japan pre-business school, and I speak some Japanese. It's also just a deep, wide market with lots of great companies, and they trade at actually reasonable valuation. So we have we have 11 countries in the mandate, from Japan in the north down to Indonesia in the south, and that includes Hong Kong and China. So it is a big universe. If you look at it, you can slice and dice it different ways. Some people look at small cap, mid cap, large cap, but we're an all cap fund. We can invest across the market cap spectrum. I would define the minimum market cap for a company we can invest in as the size of the AUM we manage. We're currently raising the first $100 million. So basically $100 million is the current minimum threshold. We're going to then raise $200 million next year. So effectively, if I think out 3 years, kind of 300 million is the minimum market cap. And then on trading volume, we really prefer at least $500,000 US per day. But that gives us a universe of about 10,000 securities. So that includes the A and the B shares, the commons and the preferred shares, et cetera. And then on the team, we have a team of myself plus 4 analysts, and then we have a COO who's experienced. He's been COO for a couple other funds for about 15 years before joining Parkway. In terms of the analysts, the senior analyst is Korean American. He's spent 15 years in Asia. He ran his own fund for a while, global long short. He has a lot of experience in Japan, so he's helped me a lot with the Japanese names. We also have 2 junior analysts who are Chinese. One is more of a quant analyst. The other is a fundamental general analyst. And finally, our most recent hire is a Korean guy. He's 26. He speaks, in addition to fluent Korean, also fluent Japanese, and he's been a great addition to the team. So I think we've got diversity, and it's really important that we have diverse opinions. We don't separate it out in terms of everyone here is a generalist, and people can follow their passions and follow what interests them. But the goal of the process is to go from this large 10,000 stock universe to a more manageable, smaller subset of the universe, which we call the farm, of about 150 names. And if we can understand 150 names collectively, and we know where we should be buying those names, we can then trade within that smaller universe.
And you mentioned in that response that you have a quantitative analyst on your team. I'm curious about that role, and if that person's part of that person's job is to distill that universe from 10,000 down to 150, or is that not like you already have that list and you're just mining for, kind of additions to it?
Yeah. So for example, I'm going to the Philippines next week for a really good conference. And the Philippines is not a major part. I mean, it's part of our geography and our mandate, but it's never going to be a large chunk of the fund. But within the Philippines, we currently have about 6 names out of in the farm from the Philippines. So Philippines is a pretty easy one because once you apply the market cap and the trading volume restrictions, there's only about 40 or 50 companies that are investable there. And so the quant analyst can help me to kind of look across that universe and to see which meetings we should try to have, which companies we should better understand, and which 5, 6, 7, 8 companies should we look at in the Philippines. And once we have those companies set, they're in the farm, we have target prices on those companies, and then we can kind of just really focus when we see news on the Philippines. If it doesn't relate to those couple companies, 7 or 8 companies, we can ignore the email. We can just delete it and move on. So that's an example of how the quant analyst can help us with that. We also look at it by sector. So I mentioned briefly the B share company we own in China. That's in the alcohol industry. And if you look across Asia in alcohol, there's companies, Japanese beer companies and Chinese white spirits companies, and there's a whiskey company in Singapore, and there's a gin company in the Philippines. Anyway, you put it all together, and there's about 30 companies to choose from. And we had among those 30, both the A and the B share of this company in China. And it just turned out that the B share was a really attractive way with the discounts to get a lot of growth in China from premiumization and also reasonable yield. And we thought that was the best way to play the alcohol sector within Asia. And so it kind of gets to what's interesting is having 11 companies or 11 countries to choose from. We can look among all those companies or those countries and try to find alcohol on the best terms possible. And so that's an exciting example for us of where the quant can help us to narrow a universe, whether it's by country or by sector.
And as you were thinking about those 11 countries and where to focus, time and capital, how did you think about the emerging market versus maybe, I guess, the more developed market? I'm thinking mostly Japan there, but like, how were you thinking about that split and where you think the attractive opportunities are?
Yeah, so geographically, the way we break it down is we have 3 groups of countries. We have North Asia, which is Taiwan, Korea, and Japan. We have Hong Kong and China, and then we have Southeast Asia, which is basically everything else. And what I've committed to investors is we're not going to go over 50% of the book in a single block of those countries.
Got it.
And so that means currently we have about 46% of the fund in Hong Kong and China. We only have one company that's listed in China, so it's basically 3% China, 43% Hong Kong. But there are opportunities today. I mean, Hong Kong's been a really beaten up market. I've lived here for now 18 years, and it's been through a really tough time the last 4 or 5 years. It started with the protests, and then China and some different changes in politics. And then we had COVID and a pretty heavy-handed response to COVID, which drove some people and businesses out. But I think what we're seeing now is Hong Kong is coming out of that period. Generally, bear markets don't last this long. Hong Kong is certainly not a zero. It's a great place to live. And so as a value investor, I look across developed markets globally, and Hong Kong is one of the cheapest developed markets globally. There's a lot of yield. There are very strong balance sheets, big dividends. There's some growth. And so, yeah, we're going to have an outsized exposure to Hong Kong because it's in our backyard. We see it every day. I walk by some of our businesses on the way to work. And it's just, it's nice to really see it day to day. And that's why we have an outsized exposure to Hong Kong. Now, as US rates come down, that's going to be very positive for a lot of our higher yielding companies in Hong Kong. So there could be a rotation next year, into more Japan, more Taiwan, and perhaps into more Philippines, Indonesia. But we're going to wait for these rate cuts to play out before we sell our high yielding Hong Kong stocks.
And you mentioned that one of the reasons you left Overlook was the inability to really invest in the companies you wanted to, whether it's the B shares or just smaller companies, because of the fund size. And I know that you've also talked about limiting your fund size to make sure you can continue to make investments you want. Love to hear how you're thinking about capacity in this strategy.
Yeah, so there's nothing magical about $300 million as a capacity target. It is about 5% of the size of the fund that I left. But I think that broadly speaking, you always want to manage, you want to have more ideas than you have capital. And that's true today. I mean, we're running the fund at about 2% cash right now, so 98% invested. If we had capital tomorrow, I can put it to work in a heartbeat. There's just so many ideas we have. And every Monday we have these meetings and the team brings forth ideas and we discuss it and we put the names into our farm and we assign them target prices. So I think 300 is a good number. It will limit some names. I mean, there are some incredibly cheap microcaps, sub $100 million that I wouldn't mind owning, but if they trade $20,000, $30,000 a day, it's just very hard to buy that at an institutional level because you just can't get, there are limits to how many days of volume I want to hold. And so we have to always ignore things. And that leaves opportunities for other maybe retail investors or microcap funds. But I think $300 million is a great size for us, and it still leaves us ample opportunity in a wonderful universe to look through.
And we've talked a fair amount about the process already, and haven't even gotten to the strategy yet. And so maybe let's dive right in there. You call yourself a value investor. For someone who is new to Parkway, how do you describe the investment strategy and philosophy?
So I think this goes back to the prior firm, and we tried to get some sort of attribution analysis as to how we did well. And really, we had a great period. I joined in 2006, but Richard started it, from 1999, post Asian financial crisis until COVID started, almost 20 plus years. Fantastic record. I think it was mid-teens performance. But as we broke that down, we realized that the majority of the returns, something like 75% of our returns, were coming from earnings growth. And I talk about earnings growth, it's portfolio level earnings growth, right? So you have to dollar weight average this. You have to look in arrears. You have to look behind. And so you don't know your earnings growth until April or May of the subsequent year, looking backwards. And there's different ways that we would calculate this. But what was great about that fund was for 20 years, we never had a negative earnings growth year. Whereas if I look at our benchmark, Parkway's benchmark, which is, it's a FTSE index called ACAP XIP. That's all country Asia Pac, excluding India, Pakistan. Anyway, look at that index, and it's only been around since 2006, but it's compounded at only 5%. And that's been mostly from dividend yield. So they've really only achieved low single digit earnings growth. And if I look at their earnings, right, if you have a Bloomberg, you can check on the FA screen, the fundamental analysis of an index, and every other year is a negative earnings year, right? So basically the index tells you what not to do. The index tells you how not to make money in Asia. And that's why everyone is so frustrated with Asia, including, by the way, Asians. A lot of Asian wealthy families have not made money in these equity markets, nor have a lot of Western institutions. And so they're saying, okay, well, forget about it. Let's just put it all in S&P or NASDAQ. But in my experience, that's not right. You can make money in Asia. You just have to create a portfolio that has earnings growth. And so that's the key message. And that's really the mantra internally, is how do we get earnings growth? And I'll throw out one more number. I mean, our target is to make 13%. And 13% to some maybe sounds low, but compared to what Asia's done since this index was created in 2006 of 5, that would be a lot of outperformance. The 13% that we're trying to make is comprised of about 10% from earnings growth and at least three of dividend yield. So really it's greater than 10% earnings growth, greater than 3 dividend yield. Now today, the portfolio has earnings growth of about 23%. That's for 2024. Next year is more normalized, 13%. And we have a dividend yield current year of over 4%. So I'm trying to make this 10 plus 3, that's the framework. And we're showing on a forward basis, call it 13 plus 4.5 or so. So that tells me that it's really, because of these low valuations, it's a great time to be invested out here in Asia.
And would you say, you hinted at this a little bit, that the absolute drubbing that the S&P has had against just about any other asset class you can imagine, and this focus on passive and indexation has driven people to think that the indexation is a silver bullet across the world? And you seem to be hinting at that the way the indexes are constructed and the constituents and the earnings growth in the way that comes out of those indexes makes it an inferior way to invest in Asia.
Yeah, I think that, first off, I will never go to the US and start a fund, because it's going to be so hard to beat that S&P. It's such a great index. And the S&P has delivered a lot of earnings growth. And I think this could be a long discussion, which I don't really want to dive in too deeply, but the S&P, because of its market cap weighted system, it's tended to put winners to the top, and it's added to winners. And so if you own S&P, you're owning these winners, which have become not only American winners, but also global champions. Whereas the same is not true in Asia, right? So you don't necessarily want to buy stocks that have gone up quite a bit. I mean, one example I use is there's a shipping company in Hong Kong. It's 316 Hong Kong, Oriental Overseas Shipping Lines. It was about a $2 billion company pre-COVID. Earnings were choppy, as you'd expect for a container shipping company. And then COVID hits, and the company goes up 10x. So it goes from a $2 billion company to a $20 billion company. And so these Asian indexes said, oh, look, there's a new $20 billion company in Asia. Let's put that into our index. Let's buy this in May 2022. Well, guess what? Buying a shipping company after COVID or during COVID, after earnings are already skyrocketed, it's the wrong time to buy a shipping company. This is not NVIDIA. You don't want to own this. And so the next year, 2023, this company had like negative 80% earnings growth. So basically, the job of the active manager in Asia, especially, is to avoid these kind of common sense mistakes, right? Avoid buying low quality companies after a 10x move, right? If I look at my benchmark, the ROA of my benchmark is 0.9%. Now, the ROA for Parkway is over 8%. If you put your money in the bank, you make more than a 0.9% ROA. How bad is this benchmark? And I look at the top 25 stocks in Asia, and I see China banks, I see Japanese banks, I see China Life Insurance, Ping An. There's also loss-making companies. I mean, the only way to have such a bad ROA is either to buy losers, loss-making companies, banks, or property. If you just don't do that, the odds of you outperforming are reasonably high. But anyway, so when we look at this 10,000 stock universe, we can quickly ignore and exclude a lot of it. And we're trying to get down to those 150 companies that make the farm. And if we can stay within that, we should outperform. And then the second level of outperformance is if we can buy within that smaller universe the right companies at the right time, at the right valuation, and hold on to them, then that should be an additional layer of outperformance.
And when you think about that universe of 150 companies, how does that universe and the valuations and the security selection, what does that look like when it comes to portfolio construction, specifically number of securities and kind of average position size?
Yeah, so as I mentioned, we have 11 countries in the universe. We currently have 29 stocks in the universe. We've added Japan, that's a change, and we've got 5 stocks currently in Japan. I think it's there's a chance we're gonna concentrate a bit more from here. Maybe we'll go to 26 or 25 stocks. It's hard though when you want to have some diversification. We got 2 stocks in Philippines, we got 3 in Indonesia. It's hard when you have a wide geographic universe to have 15 stocks because you're not going to get the diversification benefits if you concentrate too much. So that's one. In terms of position sizing, our biggest stock is about 7% of the book today. But we have a pretty deep bench. If you go to number 15 in the portfolio, we're about 3.5% of the book. So at 3.5%, if this company has good earnings back to back, the stocks can move quite a bit and they can earn their way up. So if you fast forward 2 years, I would expect to have a few stocks at or around 10% of the book, or maybe even more. We would not add to a position once it's above 12%. And if it were to get to 15, we would trim. So those are the risk parameters. But I think that the concentration, you want to let your winners win. Unfortunately, ex ante, it's hard to identify for sure what the winners are. So you buy a lot of high quality stocks, you track them closely, you look at their results, and if they can outperform your portfolio, they're going to earn their way up. And if the valuations do not become egregious, you can hold on. And then with time, in year 3, 4, or 5, you'll see a concentration. But I don't want to concentrate just by buying more of things, because I want to give a lot of great companies the chance to earn their way up.
And we talked about the opportunities that you saw in either B shares or smaller cap companies. I'm curious how represented those are in the portfolio today. Coming from Overlook, as you were starting this, saying these are the kind of things that I want to invest in, but I can't. How represented are they?
So the small caps, which I define as under $1 billion USD, they're about 40% of the fund. And then I've got 11% in $1 to $5 billion companies, and then 50+% above 5 billion. And that may surprise you a little bit, but there's a couple of reasons why you want to have some large caps in a fund. First off, we're growing, we're scaling, we're taking more money. We've had new investors in every month since inception. And to put money to work, it's just easier. If all you have are small caps and B shares and German listed companies and stuff that are Chinese, it's going to be more difficult to scale up.
Sure.
And secondly, Asia's been out of favor, as you know, for a long time. And so if only, say, a small percentage of US assets wanted to come into Asia, the first port of call is not my Hong Kong listed REIT or this B share or these preferred shares. It's going to be the Asian large caps. So while I'm not overly fixated on my benchmark, I am aware of what it's doing. And I thought that I want to be positioned so that in a bull market in Asia, I'm not going to lag too much because I do own some of the larger cap securities.
One thing I'm curious about, as we've talked specifically about the discounts that you see between the A shares and the B shares, do you need that disc? Is there a play that the discount closes? Are you owning these things on an absolute basis? I'm curious about how you think you're going to make money there, because I do know that there are discrepancies in discounts that are harder to close than you might think, because of whatever different trades in different markets or different size restrictions kind of prevent the arbitrage from being closed. How have you thought about being able to make money and capture some kind of diminution of that spread?
Right. So I think the best way to answer that would be to kind of explain again our 10+3 framework of
Sure.
10% growth. Because every company we buy, that white spirits company in China is a compounder, right? So it has a geographic place, Hong Kong, China, and this happens to be a China listed security, but it also fits into the compounding framework. It's compounding because it's growing its earnings at north of 20%. And so that 20% growth is going to be accretive towards our goal of the 10% earnings growth for the portfolio. So if we can buy that growth at a discount, right, at effectively a high single digit PE with a 5% dividend yield on a forward basis, so we have a reasonable yield, we have a cheap valuation, and we have a lot of growth. and they're getting their growth from premiumization, and they're extending their inventory, which is generally, it's a bad sign. If you're a retailer, long inventory is dangerous. But if you're a white spirits company, they currently have something like 850 days of inventory. That just means that they can sell you, a 6-year-old or 8-year-old or 10-year-old bottle at a higher price point. So long inventory, just like the leader in China, which is Kweichow Moutai, they've got over 1,000 days of inventory, and they're selling more expensive products. And so this company is trying to catch up with that. But basically, compounders, we need to understand what the business is. And so before anyone pitches a stock at a Monday meeting, they tell us, what are we looking at here? Is this a compounder? Is this a defensive, or is this a deep value? So I don't need the spread to narrow for us to make money. All I need is, if the entry multiple is the same as the exit multiple in 3, 4, or 5 years, what we're going to make should be our earnings growth and the dividends we collect along the way.
And if the spread closes, then it's just you get it. It's just gravy in a lot of ways.
Yeah. So there's, in our framework, there's 3 ways to make money as a long-term buy and hold investor. This is true if you're buying a stock or an index. There's the earnings growth, the dividend yield, and then there's a miscellaneous. Now, in Asia, the miscellaneous has 2 parts. Generally, it's FX, because we think in US dollars, because our investors are generally also thinking in US dollars. So there's an FX gain or loss. And so that depends on the strength or weakness of the US dollar. And there's multiple expansion or contraction. I'm not a macro person. I don't have strong views on the direction of FX and currencies. But I think that if we buy things cheaply, right, that we're more likely to get a re-rating, which is multiple expansion, than a de-rating. Certainly across the portfolio, certain stocks will de-rate. That's just the nature of the beast. But hopefully we don't forecast multiples. We just think if we buy things cheaply or at fair values, we should be able to make, on a long-term view, the earnings growth and the dividend yield. And perhaps we make a bit more from multiple expansion. If you start a fund like we did, or like I did in January 2024, it's hard to do. You're coming out of a bear market. You are probably more likely to get multiple expansion than contraction because of the vintage, but that's not really part of our investment thesis.
You use a word in your responses that is near and dear to my heart, which is compounders. And you contrast that with, defensive and special situations. I'm curious, when you are in that Monday morning meeting and someone says this is a compounder, what kind of characteristics are they describing?
So every company that is pitched internally comes with a model, and the model looks out about 3 years. And these are not complex DCFs. They're not like 7-tabbed models. These are 1-tab models. They're pretty basic. And we focus on the operating metrics. And so to be a compounder for the portfolio, we haven't talked about defensive yet, but if we want greater than 10% earnings growth for the portfolio, and the defensive stocks don't give us that earnings growth, the compounders need to have about 12% plus earnings growth. And another point is, if you're in Indonesia historically, or Philippines, we've actually lost money on the currency there historically, 2% or so per year. So the hurdle for the EPS growth is a little bit higher to put a name in the fund if it's in Philippines or Indo. But yeah, so if you're going to call this a compounder, and we have currently, like I said, almost 80% of the fund is compounders, what is your pathway to 12% plus earnings growth? And the further you are in North Asia, the closer to 12% we can go down, right? So in Hong Kong, it's a US dollar economy effectively. And so I'd much rather have the 12% earnings growth in Hong Kong than a 12 growth in Indo. So, but we look at margin profile, we look at returns, we look at the segmentation of the revenues, and we also have had meetings with management. And what is our take on the management? Is this a high quality team? Is it a high quality business? We look at things like margins and stability of margins and pricing power. But those are all the bits that kind of go into our decision as to whether or not this fits into the strong compounder framework. But one last thing I'll say about this is 12% is achievable, I think. And it's like hitting singles and doubles in baseball. If someone comes to us with hey, this is going to grow at 30% or 50% for the next 3 years, I am skeptical, right? Because that to me is probably going to be a more volatile stock. And while there could be more upside, there's probably more downside as well. So we have a preference for, I mean, certainly mid-teens, great. High teens, maybe, but how much risk are we taking? But low to mid-teens is perfectly fine. If we can make low teens, we can double our investors' money every 5 or 6 years. Everybody's happy. We've got a great business. We're going to outperform. So that's really what we're focused on.
And when you have a deep bench of defensive stocks and compounders, I'm curious what it takes to for a deep value situation to kind of show up in the portfolio.
So maybe I'll speak about defensive first and then go to deep value. So defensive companies, they have lower growth and they have lower beta generally. They have higher yield and lower EPS volatility. So these are companies that are going to outperform in bear markets. It's important, on a down day or down week or down month, what I want to show to my investors is, hey, yeah, the markets in Asia, it's been a tough month. Markets are down 5, but guess what? We're down 3 or 4 or 2. That's a good month, because if you can outperform in the bear markets, it's okay to lag a little bit in the bull markets, because through cycle, you should be able to outperform. So defensive stocks currently are 16% of our portfolio. These happen to all be listed in Hong Kong. And so a big chunk of our Hong Kong, China exposure is in these defensive companies. This includes a couple of utilities and a REIT that I just wrote about for the Q3 report. That REIT, it yields almost 10% in Hong Kong dollars. It's a very steady 10%. I think that's attractive, not only to local Hong Kong-based investors, but as rates go down to the US, if American retirees wanted some stable income, to make 10% in HKD, which is effectively USD, is not a bad place to play. So that's the defensive piece of the portfolio. And the third piece is deep value. We currently only have about 6% of the fund in deep value, so it's not that important. But these are neither compounders nor defensives. And generally, there's a catalyst for why these companies may go up. And so kind of it's a way for us to invest in companies that don't fit neatly into the compounder or defensive framework.
And you mentioned that your process basically eliminates 98% of the market of these Asian listed companies in your 11 markets, and that you're focused on the top 2% of all these companies. It serves to reason that a lot of other people could run the same screens and come out with these compounders. Aside from the kind of A share, B share discrepancy, I'm curious why a company that you think is that high quality and growing that fast would ever be materially mispriced, or systemically companies like that, why they would be mispriced.
So a lot of investing, I think, is best learned via apprenticeship and mentorship, and so that's where I'm very grateful for my experience. So a lot of the companies that are currently in our farm are companies that I've had direct experience with, companies that I've followed for a decade plus while at my old firm. It's really to be in the farm. The most important thing is that it's in your circle of competence. So I'm not here saying that we're going to miss a lot of great companies in that 98%. So, but companies that we don't look at, that we don't spend time on, that we don't buy, that go up, it doesn't hurt us, right? That's great. Someone else made some money. And we realize that there'll be plenty of errors of omission because we can't cover the whole universe, and that's fine. But we just have to make sure what we are covering, those 150 companies in the farm, that we really understand what they are. They're in our circle of competence. We've met the management. We have the model, right? We have forecasts, and we've set target prices so that if we buy at this target multiple, we should not lose too much money. I think that's the name of the game. It's just understanding what you know, having done the work, and then every quarter or every half year when the results come out, you're on the call, you've updated the model, and you take a view. Is this performing as expected? So a lot of the companies here, it's not so much we're finding them from screens. It's from a bottoms-up fundamental understanding that you get from spending time on the ground. We're all based here in Asia. We go see a lot of companies. That's a big part of our process. And as we get more and more confidence, it's more likely that a company can enter the farm.
And I know that you're relatively constructive about Chinese stocks at the moment. I get notwithstanding stimulus talks and recent run up in shares. It's a pretty contrarian perspective, at least when what you read and hear here in the U.S. So I'd love to hear from you what you think is attractive about the Chinese market at the moment.
Well, I'll just start with my view of it, which is that Asia generally has good demographics, economic growth. It's a peaceful place and it's a prosperous region. And with that, I think that if you're a US based or European based or an Asian based investor, whether it's personal money or institutional money, I think that deserves some place in your portfolio. I don't think it's a zero. Secondly, I think a lot of people, if they follow, say, MSCI, ACWI, the World Index, they're not getting much China at all. In fact, I think they're getting more France and more English exposure than China, which really doesn't make sense to me. I see a lot of high quality companies in China. They're getting better and better. You can see the cars they produce. You can see the appliances that they make. And these aren't companies that are going to carry huge multiples. But if they're growing and they're cheap and they're well managed, then I think you might want to own some of those. So that's where I'll start. And then secondly, I'll say that I think that to make real money in investing, it helps to be contrarian. It helps to be early, and valuations do matter. And so when I look across, I don't look at the US very closely, but I think the S&P is on something like 24 times earnings. Well, Parkway is on 10 times forward earnings, right? It's much cheaper. And so I think it kind of makes sense. If you're based in Ohio or North Carolina or wherever, where do you want to have some of your portfolio in an area with growth, strong balance sheets, companies doing the right thing in terms of buybacks and dividends, diversification? What if the US dollar goes down quite a bit because of politics or what have you? It may make sense to have an unhedged, long-only exposure across a broad array of Asian countries and companies. And so that's kind of my starting point. So,
and I'm sure you get this all the time, given that a lot of your investor base is from the US. It's the so-called China is uninvestable idea, and people have concerns about governance and property rights and politics. As I said, people probably almost always bring this up when they're meeting with you for the first time. How do you respond to those concerns?
Yeah, so obviously I disagree with that statement that China is uninvestable, and you can see that if you look at our monthly report of 46% of our fund is in Hong Kong and China. It helps to be out here, and I watch Bloomberg and CNBC occasionally, and I'm not sure that the pundits who speak about China, I'm not sure exactly what their background is, but if they haven't been to Hong Kong or China in a long time, I would probably take their comments with a grain of salt. It's a complicated world. I don't want to get into geopolitics or elections or anything like that. But I do think that let's say you lead an endowment, and maybe your endowment is an Ivy League school, and think about the makeup of that school. Think about your student body. What percent are Asian? Yeah. Think about your faculty. What percent are Asian? And think about your alumni and donor base. And then answer the question yourself. Is China uninvestable? Is Asia a zero? Is that really respectful to the makeup of your global institution? It's not. So to me, it's clear that China deserves a place. And then when you think about public versus private markets, and I know there's a lot of institutions who have money stuck in private markets in Asia, especially in China, and that's maybe makes them reluctant to add money to the public markets. But if you're going to put money in private markets, you should be compensated for it. And if I look at my portfolio, I look at the low multiples, the growth rates, and the high yields. I'm not sure how you can put money into privates today and get better terms than that. So I think we've got this great opportunity. I think we've launched at the perfect time, and I think people can make a lot of money here. And the other thing I'll just say on this is that I think there's some lazy analysis in the West that maybe extrapolates this great performance of the US. If you were to decompose the S&P returns, there's an element of, there's earnings growth, but part of that is from lower taxes. You can't keep running taxes lower and lower, and there's a lot of multiple expansion. So if you think that it's your right to get a 13% return in the S&P for the next decade, just think about, how are you going to get that? Is it going to be from more leverage, more buybacks? Is it going to be from multiple expansion? Is there really 13% earnings growth in the US? We think we have a recipe to deliver 13% plus over the next 10, 20 years in an uncorrelated fashion. And I think that's super exciting.
I think it's would be a good time to talk about a specific investment, because we've talked a lot about process and philosophy and structure and kind of portfolio construction. So I've seen a detailed presentation you delivered at an Irisone conference on Haier, the Chinese appliance manufacturer. Let's talk about that as kind of an example of how everything we've talked about manifests itself.
Sure. So Haier is a company that I've come across. It's one of the three major white goods companies in China. The other ones are called Meidi and Gree. And so it's a sector that I've followed and we've looked at in my old firm. But it's interesting because this was a very competitive sector, and I won't go back too far because I don't want to take too much time. I think I did a podcast on this one, which goes about 40 minutes. So I'll try to summarize. But basically, the company started 100 years ago in Qingdao, and they were known for making refrigerators. And so the company listed in 1993, it's been a total compounder. This has been something like it's returned 90x if you bought the IPO, and they started paying dividends right away. So a lot of cash flow. And if you compare the 90s, in the 90s, I think Electrolux was a global leader in white goods. And then in 2000s, it was Whirlpool. And circa 2010, Haier became the leading white goods appliance maker globally. And today they make something like 100 million appliances per year. When I compared the big three in China, what I noticed was for a long time, they didn't make very good margins, right? Because it was really competitive and they were fighting it out between or amongst the three major players and the other global players. And OPMs were mid-single digits, right? And what's changed is I think they've each kind of gotten their niche. So, for example, Gree has about 85% of its sales in the HVAC sector. That's heating, ventilation, air conditioning. And media or Meidi is approximately 50-50 HVAC and others. And the difference with Haier is it's only 16% HVAC. And the rest of it is refrigerators, kitchen appliances, laundry appliances, etc. And when I think about HVAC, this is actually quite a dangerous sector because the HVAC sector, if you look at Gree, it's 88% China. So it's basically a pure play domestic aircon business. And so they're selling their air conditioners to two major buyers. One are commercial property developers, and the other is to individuals doing a house or an apartment renovation. And as we all know, there's some problems in the China property market. And so while the Chinese property players, they are completing what's already been started, there aren't as many new starts, and nor should there be. So I think there's a problem in the HVAC sector, and Gree is most exposed to that. And meanwhile, Haier is least exposed. So that's one piece that I liked. The second piece that I like is the geographic distribution of Haier. And Haier is now about 48% China. So it's the majority of sales are non-China sales. There was a transformative acquisition in 2016. And I polled my business school classmates in a WhatsApp group chat. And I said, okay, how many of you know that GE is owned by a Chinese company? And I think only 3 out of 30 said yes, they knew that. So if only 10% of these MBAs from Yale know that, it's safe to say that most Americans aren't aware that GE is owned by Haier. So this deal was done in 2016 for about $5.5 billion. And in hindsight, what was really brilliant about this, and if we look at where GE is today, it's about a third of Haier sales, but they've more than doubled, or they've almost doubled the revenues. The CAGR is over 7%, and they've expanded margins, right? So they've more than doubled EBITDA comparing, say, 2015 figures to 2023 figures. So Haier has managed GE quite well. and they've kept the production in Louisville, Kentucky. So it's one of the major sources of labor for Louisville, and it's a good employer. And they've kept production domestic. So your GE refrigerator or laundry machine is made by Americans in Louisville. So this is not tariffable. And so as we get to today's politics, they've really been smart to keep production local. And they've also bought other brands. So it's not just a US story. In Japan, they own the Sanyo business. In Australia, New Zealand, they bought Fisher Paykel. In Italy and Europe, they bought a brand called Candy. And they also self-developed a brand called Casarte in China, which hits the higher price point product. So they've got even higher market share above the 10,000 RMB refrigerator space than they do at the sub 10,000 RMB. So above 10,000 is mostly the Casarte brand, and below 10,000 RMB would be the higher brand. So those are a few reasons why I like the company. Now, when you get to the valuation, as I mentioned before, there are three share classes. There's the Shanghai listed shares, about 6 billion shares in Shanghai trade, and then there's about 3 billion shares in Hong Kong, and then there's 270 million shares that trade in Frankfurt. So you put it together, you've got about 9.3 billion shares, and if you're a large cap fund, you might be interested in this higher company because they own GE Appliances, which is GE is kind of on some brand surveys I've seen, it was a top 30 global brand, and Haier itself on another survey I saw was a top 10 Chinese brand. So when a Chinese brand owns a global leader, that's a fantastic combination. But you might want to buy Haier in Hong Kong. It trades at a 10% discount to Shanghai. It's on about 12 times forward earnings with a dividend yield of about 4%. And that's reasonable. It's a compounder in our framework because the earnings should be able to grow at north of 12%. But then when you look at the discount, that if you buy this company in Germany, it's currently on about a 60% discount. So that means if you buy in Germany, you have this on about a 6 times forward PE basis with over 9% forward dividend yield because they're increasing the payout ratio. So now I've got a compounder. It's also defensive because it yields 9%. And then lastly, I could call this deep value as well because that discount could narrow, especially as the earnings grow and the dividends grow faster and people find this as an attractive buy and hold investment. Now, one day we could wake up to the news that Haier, which is shares in Shanghai and Hong Kong, decides to take out the entire German listed share class. And then we'd make a lot of money overnight. I guess that'd be good news, but I'm a long-term investor here. It's our largest holding. As long as they can deliver margin expansion and they can keep growing, they keep buying new brands. I mean, they just bought, late last year, they bought Carrier's refrigeration business. So they're going to expand. That deal's going to close, I think, in either Q4 this year or Q1 next year. That's going to lead to extra growth in 2025. They also bought from Electrolux, a South African business, a few months ago. So they're still using their surplus cash. It's a net cash company to acquire, roll things up. And I think it's a fantastic company with great management. So that was a long spiel about Haier, but do you want to talk some more about it? I can.
No, I think that's a really good summary. And it really speaks to almost all of your elements, right? It kind of ticks all three boxes: defensive, compounder, and deep value. It highlights the share class arbitrage that you focus on, or at least a component of that. So I think that's a great example. I never want to leave a discussion with the manager without talking about mistakes. Because someone who has very publicly made mistakes myself on podcasts, no less. Something that I'm always thinking about and how to get better from that. So I'm curious if there's any investment mistake that was so profound that's forever changed the way you make decisions.
Yeah, I've certainly made. I like to invest, and I've invested privately in various ventures over the last 15 years, and so I've made some mistakes there. But I think on the public side, let's just think back a year. I went to the same Philippine conference that I mentioned before, and I saw a company called Philippine 7-Eleven. And at my old firm, we made a ton of money in in the Thai 7-Eleven business, and it looked very similar. They had an aggressive store rollout. They were building out the brand, and it was clearly a compounder because you had new store growth, and then you have same store growth, and then you have margins increasing. So very clear path to mid to even high teens earnings growth, and it was on a low teens PE. So it was a cheap stock. What turned me off was the company was about $1 billion USD market cap at the time, and it still was when we launched in January. So we'd done the work, we had the model, and we were ready to go. But there was and is not much liquidity in the stock. Now, I was told by the brokers, hey, don't worry, we can get you a block. But that kind of also scares me. I mean, where's this block? Willing seller, but I don't see much volume in the market. Well, the stock's up about 80 or 90% year to date. And so I feel kind of like an idiot because here was a stock that was right in my wheelhouse. We'd done the work and, we didn't swing at the pitch. So that's an example, but there's plenty of, like I said, there's 10,000 companies in our universe. There's been a lot of errors of omission, but we can live with that. We've bought instead a different company in the similar Philippine retail space, and it's been a winner for us, and it remains absurdly cheap. Effectively, I'll just go off on this briefly. It's the Philippine version of Costco. And I know Americans love Costco. I'm from North Carolina. I get it. It's a great company. But I think the last time I checked, Costco's on 50 times earnings. And here, it's a two-part business. The company's called Pure Gold, but it's a supermarket business. That's half the earnings. And the other half of the earnings are in this Costco warehouse model, which is called S&R after Saul and Robert Price. The Price brothers, they built this thing in the 90s, and they sold it to Pure Gold 2013 post Pure Gold's IPO. And we have this stock, I think, on 6 times earnings, right? So I don't know, what would you rather own? Costco in the US at 50x or Costco in Philippines at 7x? We've got a 5% yield. We got the payout ratios increasing, tons of net cash. They're speeding up the payment of the dividends. They can pay dividends twice a year. I hope they'll start buybacks. I'm actually having dinner with the chairman next week. I'm going to give him some ideas quietly, and hopefully he can make some more improvements. But this is where I want to have my money. And I'm not saying anything negative about Costco, except that when you buy something at 50 times earnings, you need to be a little careful. I'm not going to buy anything north of 30 times earnings. And really, the only stock I have, the highest multiple I'm paying is 25 times. There's a reason for that. But basically, we can get good quality companies for low multiples in Asia, and that excites me.
Sure. And you started this firm in the last year. If we're having this discussion again in 7 years, what would success at Parkway look like to you?
So what's important to me is that there is no style drift. I hope that I can repeat a lot of what I've said with you today, and not much should change. We should be talking about 10 plus 3. We should be talking about compounders. There is a role for defensive stocks in the portfolio, and there may be a minor role for deep value companies. We will be an Asian focused business. We should have around 25 to 30 names, and the geography is not going to change. The benchmark's not going to change. The targets aren't going to change. We're trying to beat 13. If we do that, we'll beat the index. We also want to beat the S&P 500 because I think there's an argument to reallocate away from a relatively expensive market. But those are the goalposts. So that's not going to move. And as long as I love my job, I'm very happy to walk down to work from my apartment. And as long as I'm happy doing this, I'm going to keep doing it. And I think we've got a long runway ahead. I've got a 7-month pregnant wife. So we are going to, I want to do this until my daughter graduates from college. So I think we've got a 20-year runway at least. And we've got a great team around who are excited to work with me. And yeah, I just feel very fortunate to have this opportunity to show to the world that Asia, can be a place where you can make some money in equities.
Something that comes to mind as I'm listening to that response is a question about capital flows. Do you think you need capital to flow out of the S&P and out of the US and out of other asset classes into Asia for you to be really successful? Or you think that, the earnings growth of these companies is sufficient to get the stock returns that you need to be able to hit your bogeys?
Yeah, honestly, I don't expect Western capital to flock back to Asia for not in a meaningful way, I don't think, especially not, say, a US government pension fund. It's not going to come back. And I think that's widely understood. But no, I think you can still make money out here. One thing we look at very closely are buybacks, right? So the incremental buyer of securities in Asia can be the companies themselves. They've got the balance sheets for it. This is not like in the West where companies literally borrow money to do buybacks. They've got cash on balance sheet that's just parked in the bank. It would be a much better use of that capital to go out and aggressively buy your own stock and cancel the shares. So we track this. I track it in Hong Kong because I can. It's very easy to on a daily basis. And my colleagues track it across various markets so that, especially for companies in our farm, when they're speeding up their buybacks, we're aware of this very quickly. And so that's one response. But the other one is that if you look at the multiples in Asia and you go back 20 years, we're basically at a floor multiple. So Asia's trading on something like 10, 11 times, MSCI China. It depends on which index you're looking at, but the multiples haven't really gotten lower than this. So I'm not so worried about, say, at a market-wide level of further multiple contraction. I think we've kind of hit a floor on multiples. So therefore, what's going to drive returns are going to be the earnings growth, right? And if anything, we may get some multiple expansion, but again, that's not in the base case. So I think that if companies can manage their capital well, and if they are diverting, if insiders are buying, if they're doing buybacks, there's a few take privates that are popping up out here in Hong Kong. So you're seeing the early innings of this recovery, and it's going to be driven. But the other thing I'll say is that if Asia starts to outperform, and to be honest, over the last 15 years, there's been only a few short periods where Asia has outperformed the US. But if Asia gets sustained outperformance over the US for whatever reason that may be, then there probably will be some performance chasers who come back out to Asia because, it's an easily accessible market, companies that they understand and know. So I think there will be some capital that will chase performance. But right now, the jury's still out as to whether or not Asia can outperform. I think we can perform regardless of what Asia does. I think we can, from our process and from our model and from security selection and a lot of hard work, I think we can put up reasonable numbers even in a sideways market. So for the capital to really flow out, it would take market-wide outperformance over the US markets. When that happens is anybody's guess. I think at some point in the next decade, it probably will happen, but I couldn't tell you when.
Dan, I think this has been an incredible summary of your journey as an investor, the principles that you started Parkway with and how you're employing that in the portfolio. And I know that you've answered this question, but we're going to finish to some degree, but we're going to finish with the question that we ask all of our manager guests. What is the most underappreciated aspect of the investment opportunity in front of Parkway today?
Well, I guess it gets back to the China's uninvestable debate, which is widely discussed, especially in the US. And I will just say that I'll take the side that China is investable, that there are great companies and businesses at generational low multiples out here in Asia. And we hope to prove that thesis out over the next decade plus. And I think we're in the early innings of an earnings and regional recovery. So it's exciting times. If you're ever in Hong Kong, to any of your listeners, or if you want to chat, look me up on LinkedIn and come by the office, and happy to share a meal or coffee with you and discuss what we're seeing out here.
Well, Dan, I want to thank you for being on Compounders. This is the first interview we've done with an Asia-focused investor. And it's certainly, you bring up a lot of contrarian points that I know our listeners, that will resonate with our listeners. So thanks, and we're going to be following your progress very closely.
Thank you, Ben. This is my first, I think, large-scale public interview or podcast. You were a great interviewer. You didn't make it too tough on me. And I appreciate your time and interest and staying up late to talk to me out here in Hong Kong.
Yeah. Thanks again, Dan.
Thank you.